Hi, I'm Tom Lydon with ETF Trends here in Washington, D.C. at the Charles Schwab Institutional Conference, here with Marc Zeitoun, who's head of strategic beta and head of private client advisory for Columbia Threadneedle. Great seeing you, Marc.
Great seeing you, Tom.
That's a long title.
It is a long title. I mean, I must do very little.
No, not at all. Okay, speaking of little, municipal bond marketplace has been really challenged lately.
It has.
You folks, first of all, what do advisors need to do when addressing muni market today as we go into 2019? And you folks tackle it in a different way.
Yeah, you know, we do surveys. We ask advisors what their problems are. This helps us with our product development cycle. The number one concern that they have when it comes to municipals is aligning yield with the client need. And right now, I think the muni market is very confusing for the average investor. It used to be a very conservative asset class. Everything was AAA insured.
Yeah.
And since the financial crisis,
Yeah.
things have changed. And you really need to go out and find yield in different places. So when we launched MUST, we were trying to solve for that.
MUST.
MUST, multi-sector, municipal income.
Yeah. So break it down. What does it actually do?
So it takes a disciplined, rules-based approach and allocates across 5 different municipal sectors, from GOs to revenues to high yield to quality, and then preserves an allocation that it will rebalance to on a periodic basis.
And with that, the individual constituents have to go through the sausage grinder.
That's
right?
the thing. It's you know, these are not benchmark products. These are thoughtfully constructed indices, and there are parts of each sector that we find more efficient than others, and we try to hone that portfolio into those areas.
Yeah. And if you look at that compared to a traditional municipal bond index, how different does it look?
Well, I think unfortunately a lot of advisors don't appreciate that benchmarks are weighted by their issuance size.
Yeah.
Which means that you're buying the most indebted issues, and that doesn't make too much sense, right?
Yeah.
It's not oriented towards the opportunity. So MUST cures that, or tries to cure for that, by allocating to the opportunity.
Yeah. And also credit quality and the ratings can have a big effect on allocation as well.
And advisors need to appreciate that there are parts of high yield in muni that are more efficient than others. And so the dynamics of the taxable world may not apply in the municipal world.
Yeah. All right, so talk about the current rate environment, and Fed is not keeping their foot off the gas at all. Munis aren't as negatively affected as treasuries are, but they sure are to some degree. And there's a lot of evidence at this point, based on what the Fed is doing. We're going to see rate hikes going into next year. What's that mean?
Well, we are, and we also know that municipals tend to be a bit more resilient
Yeah.
to these kinds of changes. I think if we think long term, advisors think about the income, they think about aligning with the client goal, I think allocations will be fine.
Yeah. And finally, do you think, especially since yields across the board are pretty low, that with the quality of what's offered in the municipal market, even though most invest based on tax efficiency, that even just investing there and getting those competitive yields, even if it isn't even if it's a tax-deferred portfolio, still makes sense from a diversification standpoint?
I think it does. I think that we need to look at diversification in a different way than we have in the past. For example, outside of the ETF world, Columbia Threadneedle is very proud of its risk allocation process.
Yeah.
It's really aligning with the client intent and packaging that insight, which we think leads to better outcomes in one of our solutions.
Excellent. Marc, as always, great seeing you.
Great seeing you.
Thank you.